Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies, but selecting precisely which companies will benefit can be challenging. The Healthcare Sector SPDR ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector SPDR, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, the small cap effect begins in mid-December. Will it happen again this year? We'll tell you about that. Also, we're going to get into some of the stories that I'm following on our Twitter feed. If you'd like to join us to talk about the crashing crypto marketplace, Bitcoin has fallen. Actually, it's getting creamed. 844-305-7800 is the number. Give us your first name along with your city, and we can talk about that. Anything financial on your mind. You want to talk about a specific ticker symbol, stocks, mutual funds, ETFs. Again, 844-305-7800. That is the number. We're here, and we are live. This is where we talk about the birds and the bees of successful investing. Now, taking a look at the market action of the past week or so, been very shaky in terms of stock market performance. Thus far this year, we have seen the stock market in the U.S. lead the globe, and that lead seems to be waning. We've got the total U.S. stock market now down about 0.25% since the start of 2018. Lest I remind you, this is a market that was up at one point as high as 11%. But now, stocks have given away their gains, essentially for the year. Total U.S. bond market is down about 2%. Not much shelter in bonds, especially with interest rates rising. A lot of people don't understand how that works, but we've told you so many times on the program that the relationship between bond prices and interest rates is opposite. So when interest rates rise, as they have been over the past several years, really since 2016, when interest rates rise, bond prices fall. And that's what's been happening. That's why we see such weak performance in the bond market, especially long-term U.S. Treasuries, long-term corporates, which suffer the most in a rising interest rate environment. Now, we'll tell you a little bit later about a couple of ETFs that capitalize on that trend to make it a profitable exercise when bond prices go down, ETFs that go up when that happens. So stay tuned for that. I'll give you a couple of ticker symbols for you to keep on your radar. Now, in terms of the other key areas of the market, global real estate pretty much flat. REET follows that area. Commodities as a group have not been good. They're down almost 10% on the year. USCI is the ETF that tracks a broad basket of about 17 different commodity futures contracts. Of course, oil in the news, oil prices like cryptocurrencies crashing, and anybody who was long oil, especially with leverage, is getting slaughtered. Ticker symbol VEA follows international developed market stocks from around the globe, down about 11%. Seen a lot of weakness, especially in Europe. And then emerging market stocks have been weak all year long. VWO down just a nudge over 14%. So we're seeing a lot of negative performance around the globe here. So the question is, what about your portfolio? What about your investments? Are you down more than the market? Does this current correction have you concerned? Are you panicked? Are you ready for what comes next? 844-305-7800. 7,800. If this current market correction deepens, the sell-off deepens, you're going to see a lot more people scrambling as they always do for the exits. And so the question is, will you scramble just like them? Will you behave in a manner that is pretty consistent with history for how the masses and the crowds have behaved? They do the same thing over and over again, essentially repeating and perfecting their mistakes. So will you be just like them? That's the real question. Does your investment portfolio have an adequate margin of safety? Those of us that are at retirement or already retired, does your investment portfolio, does your retirement portfolio have an adequate margin of safety? I've analyzed and graded nearly $200 million in investment portfolios, and I can tell you, this is one of the consistent flaws that I see. People operating, people investing without an adequate margin of safety within their portfolio. In other words, a cushion. That's what I'm talking about when I say margin of safety. That's the context. See, the context is not, as the great Benjamin Graham said back in the 30s, his definition of margin of safety, he applied that to selecting securities. He applied that to picking stocks. I'm taking that original concept, margin of safety, I'm applying it to your investment portfolio. I'm giving it a wider application, which, by the way, it does have. It does, in fact, have. Margin of safety is not simply limited exclusively to how we select securities or a strategy, in this case, value investing. It rather, I think, has a much broader application to a person's entire investment portfolio, namely that they have an adequate cushion or safety net within their portfolio. So this is when you see the benefit of that. Of course, nobody notices it till the floor falls out, right? But we don't want you to be in that situation of shock or surprise. We want you to have an adequate cushion, and this is why I tell you about that. 844-305-7800. I'm Ron DeLegge. This is the Index Investing Show. We're here every week at this same hour. If you'd like to join us to talk about crashing crypto prices, yeah, crap. That's what it's been for crypto investors. It looks to me like the next level of support for Bitcoin is zero. Actually, I strike that. I mean 99 cents. Right now, cryptocurrencies as a whole are not performing very well. Bitcoin, as we speak, has slid under $4,000 per coin, and it looks like we could be heading to 1,000. Lest I remind you, at this time last year, Bitcoin was trading between $15,000 to $19,000 for one coin. So now we're at about 3,500, and it seems like Bitcoin wants to make a run towards 1,000. Some of those other cryptos like Litecoin and Ethereum have also crashed and are touching all-time lows. Well, strike that, not all-time lows, but let's just say one-year lows. My exercise in Litecoin ended in the spring of this year. I unloaded my Litecoin. I think it was around $110 at the time. And I did have a small loss, a loss of about $700. The exercise I did mainly to educate myself about the crypto marketplace, how it works, how to trade, how to buy, how to sell. And it is a market that, like other markets, is very susceptible to human psychology. And when the psychology and the sentiment is negative, as it is now, there's no telling where the bottom is going to be on cryptocurrencies. As I said in a tweet earlier this week, the bottom is only reached after you, not your college buds, but after you execute a sell order and then puke. That's when the bottom is reached. So keep hope alive, because the bottom is nowhere in sight. This is the Index Investing Show. I'll be right back.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, we're going to talk a little bit about the small cap effect, what that means. It's a seasonal pattern that goes back a long ways, and I'll give you a recap on the history of the small cap effect, and we'll see if that's a trade that might make sense for 2018 as we head into 2019. Also, I want to give you an opportunity to join us if you want to talk about the sinking stock market here in the U.S. It's been really a rough waters since October, and we continue to see stocks selling off, especially in certain industry sectors like technology. Ticker symbol XLK follows that area. Been very weak over the past month or two, but we're still seeing also opportunities really in those defensive sectors. It's been the defensive industry sectors that have popped to life. So what am I talking about? Some of those really boring industry sectors that were ignored for quite some time. Places like utilities, ticker symbol XLU, as well as consumer staples, ticker symbol XLP. So these two industry sectors, quite defensive in nature, over the past 3 months have actually performed on a relative basis better than the S&P 500. So we've got the S&P 500 falling about 7.5% over the past 3 months, whereas consumer staples have increased by almost 2%, and utilities have actually decreased by about 1.5%. Don't forget that you're getting a dividend yield on utilities somewhere between 3.5% to 4%. So you've got that as an investor, but the point is that industry sectors are telling us that the market is turning more defensive. XLP follows consumer staples. Some of the top holdings within that particular ETF. Now, when I say it follows consumer staples, I'm referring to stocks within the S&P 500 that make up the consumer staples industry sector. So what does consumer staples mean in the first place? Well, we're talking about companies that are involved in making consumer products that cover food and drug retailing, beverages, food products, household products, and personal products. So think of things like toothpaste and shaving cream. Some of the top components within the consumer staples sector spider, ticker symbol XLP, are companies that you've never heard of. Companies like Procter & Gamble and Philip Morris and Coca-Cola and Pepsi. There are currently 32 holdings within XLP. Like I said, companies you've never heard of. Companies like Walgreens and Walmart and Costco. You know, stuff that you don't use. Colgate-Palmolive, Kimberly-Clark. Does anybody use toilet paper anymore? Or are we using the New York Times and the Wall Street Journal? Are we using that for toilet paper? But my point is that the market is currently quite defensive. We see that from the price action of some of these industry sector ETFs. That's why we're seeing strength in some of these defensive areas like consumer staples and utilities. 844-305-7800 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. If you missed last week's program, we have it on podcast. You can listen to it at indexshow.com. We archive every single radio broadcast that you hear so that you can listen to it on demand at your convenience. We also make the program available at iTunes as well as Google Play and YouTube. so you can listen to our program any way that you would like. Last week's program, we talked about cultivating the mindset of the investing legends. And how did they get to be legends? Well, because they think like the rest of the crowd in a manner that the crowd doesn't think in. That's the difference. They are unconventional. They are often contrarian in the way they go about their business, in the way that they invest, in the moments that they invest. When everyone else is running for the exits, the legends are likely doing the exact opposite. And so on last week's program, we gave you some of the things that will help you to cultivate that very important psychology. Now, in terms of other ETFs that I want to alert you about, and this is a very timely subject, especially with crashing natural gas and crashing oil prices. Really, energy commodities have been absolutely crushed. And we've seen really, really good performance from some of these inverse performing ETFs, which allow you to make money when prices fall, when prices go down, and in some cases when prices crash, as they are right now in the oil marketplace. And so what we're saying is for your non-core portfolio, this is an opportunity to participate in, make some money when prices go down, when prices crash. And so some of these inverse performing ETFs, and I'm going to give you some of their ticker symbols because you're going to want to keep these on your radar. Ticker symbol USOD, which aims for triple opposite performance to oil. That's called the United States 3X Short Oil Fund. Over the past 3 months, we've seen USOD rise, soar, skyrocket by almost 97%. Pretty amazing. We've seen another ETF, ticker symbol DRIP, which aims for triple daily opposite performance to oil and gas production and distribution stocks. Again, that ticker symbol DRIP ahead by almost 80%. ERY, which tracks energy stocks but aims for triple daily opposite performance to energy stocks, that ETF ahead by almost 45% over the past 3 months. So those three trades are doing quite well. And like I've said before, and I will continue saying, the time to use leverage is in a sharply trending market, whatever direction that is. I don't care if it's up, I don't care if it's down. But the point is, if that market is sharply trending in a certain direction, whether that's up or whether that's down, that's the time to be using leverage, because that's when leverage performs the best in a sharply trending market. Now, I know that trend obviously can stop at any given moment. It can reverse, it can pause, it can do a lot of things. But that's when leverage works the best, and that's why we're seeing such great performance from these triple inverse performing oil-related ETFs. And on next week's program, we'll be talking with the CEO of USCF Investments, John Love. He'll be on the program. We'll be talking about what's going on in the commodities marketplace. And USOD is one of their products. Most of their products are geared towards various sectors or groups within the commodity marketplace. For example, they've got single commodity ETPs. They've got ones linked to natural gas, metals, and then they've got broadly diversified commodity exchange traded products. But the point is there's a lot going on in this marketplace, commodities, and so how can you capitalize on that? So coming up on next week's program, John Love, CEO of USCF Investments, will be with us. Coming up next, we're going to continue our discussion of financial markets. We'll be looking at small caps. Is this the time to get in Will we see small caps outperform the rest of the market? I'm Ron DeLegge, and I'll be right back.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, some things on our Twitter feed at Index Show. That's where you find me on Twitter, and we're very active there 24/7. You can follow me at Index Show. You can tweet me. Here's a story from CNBC saying, and it's quoting billionaire Ron Barron. He's a mutual fund manager. He says that any patient investor can turn $5,000 a year into nearly $1 million. So I've got a relink to that particular story, and hint, inside of it, Ron Barron, now mind you, he's a stock picker. He says there's two conditions that need to be met in order for that to happen. Number one, you got to be patient. Number two, you got to live a long time. But he also says something very curious, very, very defining, especially as an active stock picker. He says that most investors are better off just investing in index funds and index ETFs to compound your returns. So a very, very curious take from a stock picker. And he's right. Most investors are best served in index ETFs. That's why I tell you rather consistently on this program, it's my philosophy, I teach it, that the core or the foundation of a person's portfolio should be index-linked ETFs. Index-linked ETFs that cover the major asset classes: stocks, bonds, real estate, and commodities. That's your core. After you've taken care of that priority, then you can begin to invest in other things. Other things like individual stocks, leveraged ETFs, inverse performing ETFs, oil futures, cryptocurrencies, venture capital, hedge funds, private equity, whatever other crazy ideas come to your mind. If you want to invest in that, go ahead. But only do it within the context of your non-core investment portfolio, and only do it until after you have first constructed and built your core portfolio. I see a lot of people doing it the wrong way. They're putting the cart, so to speak, before the horse, right? They're already investing most of their money in non-core assets, and meanwhile, they haven't even built the foundation or the core of their portfolio. Now, when besides never does that make sense? Who in their right mind would go about building the second and third story of a building without first constructing the foundation? Doesn't make any sense. It's not logical. It's not logical for you to go about investing that way. So build your core first. Have that foundation be on a strong footing, and then after you've done that, then you could invest in some of these non-core areas like cryptocurrencies and hedge funds and active funds and individual stocks and venture capital, cryptocurrencies, currencies, gold, silver, and all these other things. 844-305-7800 is the number. We're here if you'd like to join us. Also on my Twitter feed, I've got a retweet from one of my favorite people to follow. This is actually a sports focused fellow, and I've got a retweet of a video. It's actually a GIF of Larry Bird shooting an amazing shot. Larry Bird, that Boston Celtics legend, and he says his comment on this amazing shot is that it's not luck when you knew you were going to make it. So that's Larry Bird. He knew when he shot that ball it was going in, and so it's not luck if you shoot the ball and you know it's going in. Great point. Also, I've got a link to our program last week, Adopting the Psychology of Legends. I've got the audio on that. I've got a retweet for ETF Guide. The long-short ETF Guide has been dubbed a trader's best friend, and it's available, the fourth quarter version, and we've got a link to that. You can download that free report. It's got all of the long-short ETFs neatly organized on one sheet by their asset class. So no matter what you want to trade, whether it's stocks, bonds, currencies, commodities, oil, gold, silver, whatever, it's all on one sheet, and you can get that for free. Also, we've got people wondering, where is the market leadership? My comment to that, the market needs leadership, and it does have leadership, and it's currently located in short ETPs. Ticker symbols TECS, USOD, SPXS, and ERY. Those are some of the places where the market leadership is showing up right now. Also, you got to appreciate traders' mindsets of when it feels good to be down only, and I put only in quotes, only 2 to 4% in daily trading versus being down 5 to 15%. So that's what we've got here. Also, one more tweet at Index Show. The 2018 theme in cryptocurrencies is ugly, bloody, radical, mean reversion. That's what we're seeing in cryptocurrencies. Ugly, bloody, radical, mean reversion. It's happening in the crypto marketplace. 844-305-7800. Is there anybody out there that's listening to the program that made cryptocurrencies part of their core portfolio or core investments? So in other words, you took cryptocurrencies and you made them the bulk of your strategy, your primary net worth. Is there anybody that did that? Well, that's what happens when you concentrate your assets, your net worth, on one particular thing, whether that be, in this case, an emerging asset class, a digital coin, a alternative form of payment, or it could occur in other asset classes. People that concentrate their wealth in single stocks or single pieces of real estate. It's do or die. When things go, they go well. But when things go bad and awry, it really can be very, very ugly and dangerous to a person's well-being financially and also their health. Actually, I'm going to share this with you on the next segment because we often ignore the impact of a market correction, of a market crisis, of a market crash. We think about it in only financial terms, but actually it affects us in terms of our health. And I want to share with you a study from the University of Michigan and Northwestern Medicine in the next segment that studied the long-term effects of large financial loss. And they found a shocking correlation, a sad correlation of people that lose a lot of money, middle-aged adults, and what happens to them and to their health. So I want to share that with you in the next segment. Also, we're going to round out today's program talking about the small cap effect. The just published December issue of ETF Guide Premium is out and covers this exact, what you might call seasonal investment trend. Happens once a year, begins in mid-December, runs through early February. And I want to tell you about it, what it means, and how to trade it. 844-305-7800 is the number. I'm Ron DeLegge. This is the Index Investing Show. We're here. And I'll be back after this short break. Be here or be nowhere.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
844-305-7800 is the number. @IndexShow is where you find me on Twitter. And if you'd like to follow me, you can do that. We also have a lot of good links throughout the week and days. We also have interesting research that will help you to better your financial life. And also, we hope to improve your peace of mind and your health. Now, as I alluded to earlier in the program, a lot of individuals in the financial field focus too much on just the financial and money ramifications of losing large sums of money. Well, there's a study from the University of Michigan and Northwestern Medicine that looked at this, the long-term effects of large financial losses on middle-aged adults. We're talking about people who went on to lose 75% or more of their total wealth during a 2-year period. And according to these findings from the University of Michigan and Northwestern Medicine, these individuals who suffered these deep, deep losses to their investments, to their net worth, had a 50% greater chance of dying within the next 2 decades than those whose wealth remained stable or had increased. So the financial loss, which they termed negative wealth shock, was impactful for 2 main reasons. It can produce a significant mental health toll and also leaves fewer monetary resources for health-related expenses, write the authors. So if you want to increase your chances of dying early, then my recommendation is to suffer a wealth shock. Lose 50% or more of your net worth is all but guarantee a way to increase your mortality or risk of dying prematurely. So if that's what you want to do, just all you got to do is suffer a wealth shock, because the probability of that happening are quite high according to this study. And this is something that we bring to your attention to help you understand the negative impact, the sad impact that a negative wealth shock can have on an individual's life. Your life is at risk, literally. Not just your financial life, but your actual life. And so that's why, again, to reinforce the investment philosophy that is so simple, that I emphasize, it's a 3-word philosophy that I've given you and I want you to adopt. And that is to build, grow, and then protect your investments. Most people are just trying to build and grow, but they forget about the necessity, the important requirement to protect what they've built. You can't just build and grow, but people don't have a safety net. That's the sad part of this. Most investors and particularly those that I've analyzed and graded using the portfolio report card grading system that I invented. I've seen this consistently and continue to see it, especially with retirees and people that are nearing retirement that do not have an adequate cushion within their portfolio, and they're putting themselves at risk for premature death. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here, and as I mentioned, the just released issue of ETF Guide Premium, I encourage you to become a member if you're not yet one, etfguide.com, and again, become a premium member. And it's discussed in the latest issue, the small cap effect, which begins in mid-December. We know that the future never repeats history in the same exact manner, but there are certain identifiable patterns that have a tendency to reoccur more often than not. And the small cap effect, also referred to as the January effect, is one of those trends. Now, the origin of the small cap effect goes all the way back to 1942, when economist investment banker Sidney Wachtel, he wrote a paper titled Certain Observations on Seasonal Movements in Stock Prices, and that appeared in the Journal of Business, which was published by the University of Chicago Press. So Wachtel's theory, after observing stock prices, was that there was a general bias towards outperformance during the month of January, while small cap stocks would outperform large caps by even more. This pattern was likely due to year-end tax loss selling of smaller stocks, which would temporarily depress their prices. Beaten down small caps would then rebound in January as investors bought them back, hoping for recovery. Although this tendency of small caps to outperform large caps has been ridiculed by some Wall Street types, who especially those who promote the cute but dead wrong theory that financial markets are efficient. They're not. They're not efficient. They're mostly efficient, but they're not fully efficient. If we look at the historical data, it shows that small caps have indeed outperformed large caps during this period, beginning in mid-December up to February 1st. So if we take a look at this from 1987 to 2012, small caps as measured by the Russell 2000, no, that's not a vacuum cleaner. Sounds like a vacuum cleaner, doesn't it? Let me sell you a Russell 2000. Well, that's a small cap index or benchmark of 2,000 small company stocks. It's called the Russell 2000. And then you'll have the Russell 1000, which is its counterpart, except it tracks large company stocks. Yes, 1,000 large company stocks. So if we compare these two indexes from 1987 to 2012, you've got small caps outperforming large caps, gaining just over 6% compared to a nearly 4% gain for large caps. So about a 2 to 2.5% margin of outperformance for small caps during that 2-month period from December 15th to February. So put another way, traders who exploited the small cap effect during this period had annualized gains of 43.5% compared to just 24%. So the small cap effect has worked in the past over long periods. Now the question is, what about recent history? What's happened with the small cap effect? Well, I looked at this, and it's covered in the December issue of ETF Guide Premium in a little bit more detail. But if we look at just the past 10 years, the small cap effect has indeed played out 60% of the time over the past 10 years. Now, last year, small cap effect did not work. Large caps actually outperformed. And actually, in the previous 2 years, that was also the case. So the small cap effect, what I'm saying is over the past 3 years, has not worked at all. It's been a total failure. Before that, though, it was a success for 4 straight years. So what we've seen here over the past really several years is is hot performance, streaky performance, where small caps have consistently outperformed, and now we're going through what you might say a streaky period of cold performance, where small caps have not been outperforming large caps from December 15th through February. So far this year, just to give you an idea of what's been going on performance-wise over the past 3 months, small caps have underperformed both large and mid-cap stocks. Will that trend change? Will that trend turn? Well, we'll just have to wait and see. But we could see a rather, if the market as a whole is able to bring itself together, organize itself, and to have some sort of rally, we will likely see a pretty big pop in small cap or small company stocks. But if not, well then, this trend of underperformance that we've seen over the past 3 years, where small cap effect has not played out, will likely continue. Well, that does it for another episode of the Index Investing Show. Be sure to join us again next week. John Love, CEO of USCF Investments, will be on the program. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.